Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to share with you the most important tax rules to ensure you never compromise your interest deduction. In fact, there's 10 that I'd like to share with you. Obviously, particularly for investors and particularly for property investors, as they tend to gear to much higher levels than share investors. Typically for them, the largest tax deduction you have over the life of your investments really is interest. And it's very important that you're able to have the right documentation, structure and so forth to demonstrate to the ATO why you have claimed certain deductions. And if you're not able to do that to a very high standard, the ATO will simply just deny the deduction, and you will then have to pay any shortfall in tax. You'll have to pay for interest and penalties. So therefore, it's really important to make sure that you comply with all the rules. And whilst that's not a difficult thing to do, if you don't understand them well enough, you can inadvertently sometimes put your deductions at risk. And so here's the 10 most important rules that I think that apply to structuring investment loans. And as I said, making sure that your interest deduction is legitimate. There is actually a full chapter in my latest book, Rules of the Lending Game, about tax and implications and those sorts of things. So if you need more information, certainly that's where you can find it, of course, as a shameless book plug. Okay, so the first rule is that you only get one chance to set the maximum tax deductible loan. So that is how much you borrow when you initially first purchase an investment property or investment, could be shares. That is the maximum tax deductible loan. You can't go back later on and increase the loan again. So for example, let's say you purchase a property for $800,000 and the total cost of that acquisition is $845,000, $45 for stamp duty and so forth. If you have $300,000 of cash, then you really only need to borrow $545,000. So 845 less 300 grand, 545. Pretty simple. Now you can go and do that, but then maybe down the track you think, oops, I shouldn't have put so much cash into that property. I now need to buy a new car, renovate my home, do something that is non-deductible in nature. You can't go back to the bank and increase the loan to say 800 or 845 in fact, and pull your $300,000 out again. And the reason for that is it's the purpose for which those new funds are used that will determine whether they're going to be deductible or not. And so if you use those funds, as I said, to renovate your home or do something like that, it's not going to be tax deductible. So therefore, when you first acquire an asset, and even if that asset is in fact initially a home, an owner-occupied home, not an investment property, so irrespective of that, when you first acquire any asset, think very, very carefully about how much cash you really want to contribute to it, because you might inadvertently deny yourself some tax flexibility and future deductions down the track. The second rule is that loan applicants may not have any tax consequences. So that is, who is party to the loan doesn't necessarily determine who is entitled to the tax deduction. From the ATO's perspective, particularly with marital couples or spouses, de facto spouses, the main determining factors in regards to who is entitled to a deduction for interest is firstly who owns the asset. So if we have a loan that's in joint names that was used to purchase an asset that's only owned by one of the spouses, then that's going to be the most compelling data or factor that the ATO will look at. And then two, who's been making the repayments? So if my wife and I jointly go and borrow $1 million, and then I go and buy an $1 million investment property that's only in my name, and I make all the loan repayments that come out of an account that's solely in my name, then there's a strong nexus there that I am entitled to 100% of the tax deduction. And the way that the ATO, from a legal perspective, looks at it, it's really a partnership. We've borrowed jointly. My wife has on-lent her 50% to me, and therefore I claim the tax deduction. Of course, it's preferable, and I've got a tax ruling, by the way, that I've cited in the show notes and on the blog on the website. Of course, it's preferable and cleaner to some degree if you can match the names on the title of the property or the owner of the investment, if it's not a property, and match those names and the names on the debt to eliminate any doubt. However, some lenders' policies and procedures and processes can make that difficult and sometimes costly and sometimes impossible. So if we do have a circumstance where we have two spouses, one spouse is buying the asset, but the loan is in both spouses' name, as long as we then set up an account to make the repayments that's solely in the owner's name, that's an important one, then the names on the loan, the applicants to the loan, tend to have very little bearing on who is entitled to the interest deduction. Which leads me into my third point here, or rule, and that is that the owner must make the loan repayments. So a common mistake that we've seen is that husband and wife go and borrow some money. They buy an investment property, put it in the husband's name, and the loan repayments come out of an account or debit to an account that's in the husband's and wife's joint name. In that situation, what you risk is the ATO to argue that in fact you have both been making the loan repayments, and so any joint loans or jointly held property is assumed to be equal ownership, so 50-50. And so the ATO will say, okay, so husband borrowed 50%. Husband owns the investment property, so that's fine. We'll give him the deduction. Wife has borrowed 50%, but she actually has no ownership of the investment property. That interest is now non-deductible. So that's the risk, is if the repayments aren't made by the owner of the investment, and in fact if it goes from a joint account, and typically this is a situation in a marital relationship or de facto, then you're potentially putting those deductions at risk. Fourth rule is that security doesn't matter. What you use to secure a loan has no bearing on its tax treatment, tax nature, and interest deductibility. So, for example, I could go and borrow $1 million, secure it by my home, and use it for an investment purpose. The fact that it's secured by my home doesn't really matter. The security is irrelevant. Number 5, purpose is king. The purpose for which you use the funds and its nexus with accumulating or earning assessable income or capital gains will determine whether interest in respect to a loan is tax deductible or not. And that's loan purpose is what the ATO look at first and foremost, and that's why it's really important to keep good records so that you can show what a particular loan is used for. And if there's multiple purposes in the same loan, which I advise against, you must absolutely then have even more impeccable records. So when considering the deductibility of interest, there's three limbs or three questions you need to answer. What's the purpose? There needs to be a nexus with earning assessable income. Okay, so the purpose is I'm borrowing to buy an investment property. That investment property hopefully will generate capital gains, but it will definitely generate rental income. So tick. The next question is who owns that asset? Okay, so husband owns it. Tick. Who's been making the repayments? Husband has been making the repayments. Tick. It doesn't then matter, or it will have almost zero, or likely to have zero impact of who are the loan applicants and what security are you using to secure that loan. Quite often we get asked, well, can I borrow against an investment property, increase that loan and then repay my home loan as a way of sort of converting tax-deductible debt? So I often get asked that question, and clearly the answer is no, because it's the purpose for which you use those funds that determine whether it's going to be deductible or not. So if I go and borrow or take money out of an investment loan and use it to repay a home loan, the purpose is to repay a home loan. Therefore, that's a non-deductible purpose. Number 6, don't mix loan purposes. So it's a good segue. There's lots of reasons not to mix loan purposes. So mixing loan purposes could be using the same loan for 2 or 3 different properties, to fund 2 or 3 different properties. Or a common one would be using part of a loan to invest in property and part of a loan to invest in shares. And worse still, mixing purposes would be to redraw your home loan to make an investment. So therefore you then have some of the loan is deductible and some of the loan is not. The predominant reason for not mixing purposes is really record keeping, to make sure you have an absolute nexus, a connection with the asset and the debt, to make sure you can prove it beyond doubt that that is an investment loan. That's the key reason. Another reason is that should you want to repay a portion of a loan, you cannot do that if it's the same loan. So let's say that you've got say for example, a home loan that's $150,000. And you've drawn or redrawn $50,000 for investment, so your total loan's $200,000, and you sell the investment and you want to repay that investment loan, or you get a bonus, in fact, and you want to make a repayment. The ATO says that you have to apportion those repayments proportionately across the entire loan. So then you can't then, when you mix purposes, just repay one purpose and not the other. So you have to then split those loans out and then make the repayment. Just don't mix purposes. It's much cleaner. Number 7, redraw. Be careful using it, and that is to say either use it on purpose or don't use it at all. The thing is that redraw is counted as a completely separate and new loan by the ATO. And therefore it is the purpose for which those funds, those redrawn funds, are used for that will determine whether it's deductible or not. So let me give you a quick example. I've got a $300,000 investment loan. I receive a $20,000 bonus at work. I know I'm going to spend that bonus on a holiday in 6 or 12 months' time. But in the meantime, just to save some interest, I'm going to park that $20,000 into the investment loan. So I'm going to make a repayment of $20,000 and reduce the investment loans balance from $300,000 to $280,000. And then in 6 to 12 months, when it's time to pay for the holiday, I'm going to take that money out again of that loan. Happy days. Well, at least I thought it was happy days, but in fact now what the ATO is going to say is you've got 2 loans. You've got the original one, which was $300,000, but you have subsequently paid it down to $280,000. That is still tax deductible. But then you've got a new loan, the redraw amount, $20,000. And because you use that to pay for a holiday, and for most people, holidays aren't tax deductible, you've now got a non-deductible portion of your loan. So be very, very, very careful using redraw, and that is to say, almost never use it. Which is a good segue into rule number 8, which is it's much better to offset debt than repay it. As I said, the problem with repaying a loan is that you change the original nature or balance of the debt. Once a loan is repaid, it's gone forever. If you go and redraw that loan, as I just talked about, it's treated as a completely new loan. So therefore, in order to preserve the original tax-deductible loan balance, the best thing is to never make any repayments. But of course, we either want to notionally reduce debt through our life, or we have surplus cash flow and we want to offset and reduce debt. So the best way to do that is attach an offset account. And so using that example that I just shared with you, $300,000 $20 bonus, $20,000 bonus, if I had an offset account linked to the investment loan, I could put the $20,000 in there. It would save me interest until I needed the money. I could then pull the money out and use it for a non-deductible purpose, a holiday. But the benefit is that I never change the original tax nature of the debt, that any debt then is still deductible. And I typically counsel my clients, there are a few exceptions to this, but I typically counsel my clients to never ever repay debt. I mean, you never just say, you just don't know what's around the corner. So you're better off to have all your loans completely offset with cash than repay the debt and they're gone, they're gone at all completely. Just preserve that original tax deductible debt. Number 9, borrowing expenses are tax deductible, and it's really important to track them. So any costs that are under $100 can be claimed in the year in which you incurred them. Any costs over $100, which can include settlement fees, setup fees, establishment fees, valuation fees if you pay for them, those sorts of costs, they're deductible over the mortgage term or 5 years, whichever is shorter. And typically mortgages are 20 to 30 years, so normally it's over a 5-year period. You can deduct them on equal installments over that time. Mortgage insurance is a really important one. If people go and buy an investment property, pay for lender's mortgage insurance, they can deduct that fee, claim a tax deduction for that fee over 5 years, which is good from a cash flow perspective because quite often mortgage insurance is actually added to the loan. So you get a tax deduction, but you haven't actually paid necessarily for the cash flow cost of that expense. One really important point is that if you go and refinance the loan before you've claimed all the expenses, so let's say I paid $10,000 in mortgage insurance, I'm claiming $2,000 a year over 5 years. 2 years into the loan agreement, I refinance. So I've only claimed 2 times $2,000, $4,000 of the cost. There's still $6,000 yet to claim. Once I refinance to a new loan, I can claim that full $6,000. And so that's a really important thing. That's why I say it's important to track because you've got a depreciable asset there and you can write that full expense off in the year that you refinance. But if you don't remember or your accountant doesn't pick it up, you potentially miss out on a pretty sizable tax deduction. And the last rule is keep a really good paper trail and keep notes. What is clear to you today won't be clear to you, or probably, particularly if you've got a memory like mine, won't be clear to you in 2 years, 5 years, and particularly 10 years' time. So when you're setting up loans, when you're drawing loans, when you're making repayments, when you're doing all those sorts of things, keep really clear notes, make sure it's really clean, so that if you ever get asked, particularly by the ATO, you could substantiate your deductions very clearly. Remember, the onus is on you, the taxpayer, in order to be able to prove why a deduction is valid. The ATO doesn't have to prove that it is an invalid deduction. It just means if you can't prove that it's valid, they'll deny it, right? So that you've got a heavy burden of proof on you as the taxpayer in order to do that. And keeping clear notes, particularly around refinances, I find that that's when that can cause confusion. Particularly if you're consolidating loans, changing loans, increasing loan amounts, drawing loans for deposits for properties, these sorts of things, that can confuse the situation a little bit. So there's 2 reasons you'd visit an accountant. The obvious one is so that they can prepare your tax return. But the second reason is that they can give you tax advice, and they need to make sure that you are complying with these rules, that you understand these rules, and you don't inadvertently take some actions that are going to impair your ability to maximize your tax deductions or minimize your tax payable. Now, that's not always possible. I mean, they need to learn about something before you learn about a potential mistake before you make it, of course. But shopping around for the cheapest tax return doesn't always yield the best result for people. It's about getting great advice as well. Now, just as a quick disclaimer, of course, the 10 rules that I just discussed, just like with all things tax, there's always exceptions, there's always circumstances that need to be taken into account, and there's always exceptions that prove the rule, of course. So whilst I've provided sort of a generic summary I haven't obviously considered your personal circumstances, so please just don't go and take those rules as verbatim that apply in every single circumstance. We need to consider the situation, and you need to get your own personal tax advice. That's it for me this week. Until next week, bye for now.